Hi traders. In this case study, what I'd like to do is show you a position that we ran for 6 months on a company which is actually an exchange traded fund. In fact, on SLV. Now, SLV is a commodity ETF representing silver. Now, during this 6-month period, we were able to roll and adjust our positions, maintaining that trade until such time as we were exercised. We were able to make a 19.2% return during that period, and that doesn't include brokerage fees, but we were able to hold the position, adjust to realize the capital gain that was occurring at the same time, and make a slightly better return on that position compared to anyone who just bought the stock and held the stock during that period. So let me show you a few of the key details of this position before we look at it one by one. So we'd entered this on the 25th of November and we were assigned or closed on the trade on the 21st of May. As I say, that's 6 months and that's returned 19.2%. I have all of the details there which we'll provide at the end of this video. And as mentioned, assigned at $24 at the end of the May cycle for a 19% return. The stock itself had gained approximately $3.82 during the same time frame. I'd use the closing price, our same entry price, and the closing price of the stock. Yes, it was a 17% return, but what I will be showing you is the advantage of the covered call in providing a lower average cost as we go. So let's jump in and take a look at SLV. Now, at the time of recording this video, it's actually late July, and we can see further activity on SLV since then. But what we need to do is really go back and take a look at SLV at the time of when we first started analyzing it and when we entered the trade. So what we need to do is identify the 25th of November. I'll just find that particular date, and there we have a vertical line there to denote our entry point. So what were we looking at that point in time? Well, let's just hide history to take a look at what we were looking at. Now, based on the fundamental and technical analysis that we had conducted at the time, we were happy to enter into a covered call on SLV on the 25th of November. Our view was that SLV had a high probability of holding this support base, and that by selling the covered call we would lower our average cost per trade. So the position we'd entered was the December 22.50 call. We'd bought the stock, and first of all what I'll do is I shall place a horizontal line at 22.50. Might just adjust this slightly to make it a little bit more predominant. That's the 22.50 strike just there. Now, we'd bought the stock at 21.71, but we'd sold the December 22.50 calls at 42 cents. So our average cost on this position was $21.29. Again, I'll put a horizontal line in at that price. That's close as I can get to that level. So $21.29 was our actual break even on this position. So our view is that if SLV rallies and goes above $22.50, we'd be happy to sell our stock at $22.50, no matter what price it's at. Remembering that when you sell a call option, you're obliged to fulfill the contract if you are exercised or assigned. If the stock price declines, well, our break-even's at $21.29. If the share price is below $22.50 on the expiry date, then that will just expire. Now, straight away, we've entered the stock and our break-even is lower than where the entry price is. So let's take a look at what happens to SLV over the next month. Almost immediately after entry, the stock price had dipped. But it recovered and continued trading roughly sideways around $22.50 before finding some buyer activity. Now, on the 18th of December, and again I'll put a vertical line here to denote this, on the 18th of December, after the stock price had rallied above our sold strike, we decided that we would roll our position. We'd initially sold this December 22.50 call at 42 cents. To buy back this December 22.50 call, is going to cost us a lot more than 42 cents to buy it back and close it out. It actually cost us $1.56. So at that point in time, our break even has gained up to $22.85. So I'll adjust that up through to here. So now our break even's up through here. We're still in a gain overall in the position because the stock price is much higher. As part of the rolling strategy though, we also sold the January $24 calls. So I'm actually going to adjust our solid red line up to $24. So we've sold the $24 calls and we received $1.17 for that option. So that lowers our break even to $21.68. So our break even prior to rolling this position was $21.29. We bought back the December 22.50 calls at $1.56 and sold the January 24 calls at $1.17. That cost us 39 cents. However, whilst our break even has been adjusted slightly higher up to $21.68, we now have a higher stock price and a sold call at 24. So if at the end of the December option cycle, the stock price is above $24, we'll be assigned at $24 and sell our shares. So as the month progressed through December, the stock price did trade higher before having a relatively large correction on the 8th of January. We held this position through to the 15th of January, and I'll put another vertical line through here on the 15th. So at this point in time, the stock price is down below our sold strike. What we decided to do on this day is try and capitalize on option premium just in case the stock price continued to trade down. At this point in time, we have a short-term reversal and the stock price was looking a little weak. Now, the January $24 calls were only worth 2 cents at this point in time. So we bought those back, which obviously adjusts our break even to $21.70. But we immediately sold the February 24 calls and received 82 cents. So we actually made a net 80 cents in the adjustment of that position. Our break even was then adjusted to $20.88. So our break even is now even lower than when we'd initially entered the trade back on the 25th of November. We'd rolled from the January 24 calls to the February 24 calls. So the strike hasn't changed. And again, if the share price is above this strike of $24 on the expiration of the February options, will be exercised, which means that we will sell our shares at $24. So we're sitting pretty at the moment with a lot of downside risk left in our position just in case SLV retraces. As the month of February progressed, we then decided to roll our position again. Now on the 11th of February, which I will highlight with a vertical line, we decided to roll our position again. SLV had recovered and in fact spiked up to $28. It became quite volatile at this time. However, with the retracement back down, it started to find some support around our 24 strike. With a slight retracement and with all this time decay from the sold February options, we decided to roll our February 24 calls out to the March 25 calls. To buy back the February 24 calls, it cost us $1.08. So our break even actually lifted to $21.96. But because we sold our March 25 calls at the same time, we received $1.14. We actually had a net credit of about 6 cents. So our break even was actually adjusted down to $20.82. But we'd rolled from the February 24 calls up to the March 25 calls. So again, if at the end of the March options, SLV remains above $25, we could be exercised, which means that we would sell our SLV shares at $25. We've rolled from 24 up to 25, realizing an additional $1 in capital gain if exercised, and we'd actually adjusted our break-even a little lower. Now, as March progressed, the stock price dipped below 25, and on the 19th of March, the share price closed below the $25 strike, and that meant that the option expired worthless. So we held our shares and no longer have the obligation of the sold March 25 calls. After a couple of weeks, with the stock price dipping lower, our risk was that we were finding SLV starting to form a new downtrend. We had lower highs and lower lows. My concern at this point in time was that potentially we would see another downwards leg, and we wanted to lock in some more options premium and lower our break even further. So on the 7th of April, we decided to sell the May 24 calls, which we received 69 cents for. So the strike was $1 lower, and we received another 69 cents, lowering our break even to $20.13. Now that's just about at the bottom end of the chart, so I'll just zoom a little further out. Now we held the May 24 calls right through to expiry. So as May progressed, we can see the stock price started to break higher. Our fear of the downtrend forming was negated. And on the 21st of May, the stock price closed at $25.50 and our $24 strike was assigned. Now, potentially we could have rolled this again, but based on the fact that the stock price had trended too strongly for us, we didn't view rolling this position whilst the stock price was at long-term highs would be worth the rate of return that we would receive. So we just let this position get assigned at $24, selling our stock for a 19.2% gain. So on this chart, we can see where our final position was at, with the $24 strike highlighted with the red solid line, horizontal line, and our break even down at $20.13. So from our point of entry, we'd actually reduced our risk. If SLV had traded down and broken further down, we would have less loss on our position than if we just bought the stock on its own. Now since then, SLV has continued somewhat sideways and is actually trading lower than the $24 strike. We've actually accumulated SLV again, and we're starting to write covered calls again. So hopefully I've been able to highlight to you that by selling calls against our stock, we've been able to lower our break even, which is reducing the risk of your position. Now, some will highlight the fact that by selling the call, we cap our upside potential in the underlying stock. So you don't enter the covered call unless you are willing to sell your stock at that specific price. But as I've highlighted, we've also been able to roll our position, maintaining a good break even based on technicals on the chart, but at the same time by being able to also continue rolling the position, selling calls, and maintaining our gain. Now with SLV, it had retraced after we had then been assigned, and that offered us an opportunity to re-enter at a lower price. So this is one example of a cover call over multiple months. We have a slight advantage in this case. Sometimes we'll have a much better advantage because we've been able to work those options around the stock a lot more. I hope this has been a great example, and if you have any questions, please feel free to email me on info@stockmarketempowerment.com. Hi covered callers. I'd like to offer the group a special deal to one of my key services. If you're struggling to choose covered call positions for yourself, or you're time poor and need an expert hand in helping choose the right positions for your portfolio, then why not take a look at my covered call recommendation service. Now, as a member of the Covered Call Strategy Group, I'd like to offer you a 1-month trial for only $1. There's no obligation to continue subscribing, but I'm confident that you're going to get great value out of this service. I've been providing covered call recommendations for nearly 15 years to thousands of clients. My covered call balanced portfolio recommendations provide a monthly market and economic review, covered call recommendations based on monthly cyclical option writing, and end-of-day position updates when action is required. So now that I've broken away from the firm, I'm an independent analyst and trader whose sole focus is in managing strategy and premium hunting. Now, my results will speak for themselves. So take a look at the trade recommendation service by clicking on the link below, and I look forward to seeing you in the group. Happy trading.